Are certainly hoping the worst is over, with shares already down more than 75% year to date. And we begin, though, with our talk of the tape. Another hawkish Fed member speaks, another move higher in interest rates, and another cooling off of stocks. Stop me if you've heard this before, but it is becoming the norm. The question is it too much to overcome for the bulls, who are hoping this rally has some more legs and point to strong earnings as a reason why? Well, let's ask SoFi's head of investment strategy, Liz Young, New Edge's Cameron Dawson, and Truist Keith Lerner. All three, of course, are right here at Post 9. Liz, I'll ask you that first. I mean, should we bet on the rally resuming or rolling over, because rates remain very much the story?
So rates do continue to be the story, but I think actually the bigger story right now is earnings, and we're really going to heat up into earnings season later this week and next week. We have to remember this earnings season, we're hearing about a quarter that started in July. So really, companies still had a lot of pricing power. There was still an ability to pass through those costs and grow their revenue. I don't think earnings are going to give us this terrible alarm bell this quarter, but it's not over yet. So the question of, can the rally resume? Can we still go up from here? Sure. Do I believe that it's lasting beyond a few weeks or maybe a month or beyond the next Fed hike? No.
But are you suggesting, though, that earnings can trump rates? That story is going to be good enough and maybe, dare I say, surprising enough that a move higher in rates won't derail this move that we're experiencing now? Today, obviously, we're down as rates continue to go up.
If it's a big enough story, yes. I mean, so far earnings have been pretty good. If we start to get some surprises to the downside, or we start to get guidance for 2023 that's materially different or materially worse than it was before, yes, I think they can trump it, because the market already has rates priced in. The market's already expecting rates to be a problem.
They are. I mean, the market, Fed funds are now at 5%, Keith, mid-23. So the market's gotten there. At least part of the market has. What do you think? Do we have more room to go here, or are we about to give it back?
Well, I think time frame is important. On a short-term basis, we do think there's a little bit more room for this rally. You are still deeply oversold. 20% of stocks above the 200-day moving average. Sentiment is pitiful. And even today, look at today. You had rates up a lot. The market actually held in there pretty well. Energy was up. Defense companies were up. So you're still seeing some pockets of strength. So to answer your question more directly, we think the short-term rally has longer to go, but the medium-term outlook is more challenging, because this is the other thing. As you look out, with these rates moving up, the equity risk premium is now the lowest since 2010. So what does that mean? Stocks are getting cheaper on an absolute basis, but on a relative basis, they're actually becoming more expensive. So we would use that rally to reposition to become more defensive.
So Cameron, who's been very defensive, joined today by David Einhorn of Greenlight, who writes in his letter, and I want your opinion to that. This is your opinion on that. This is to his investors, quote, "As long as official policy is to make the stock market go down so that people are less wealthy, so that they buy fewer things, so that prices stop going up, all while doing nothing about fiscal policy, we believe the correct posture is to be bearish on stocks and bullish on inflation." Sounds like you guys have been speaking.
Yeah, well, that's exactly what the Fed has told us that they want to do. They want to see financial conditions tighten. To see financial conditions tighten, you have to see valuations go lower. And that's why the Fed is okay with this financial market volatility. And it's also why the Fed is okay with higher unemployment, because they need to see demand go lower, which means that valuations go lower, earnings go lower, and that's why this market still has challenges.